Okay, solution to the mid-year acquisition question. Again, here's our spreadsheet, all random numbers. First order of business, copy, paste as values. Okay, on April 1st, Big acquired 95% of Little Company's voting stock for $164.35. The fair value of the non-controlling interest on that date was $8.65. On 4/1/20, Little had the trial balance indicated, so assets, liabilities, equity, sales, expenses, and dividends. Little's assets and liabilities all had fair values equal to book value except for land, which was undervalued by 19. At the end of the year, Little reported net income for the year of 52 and paid total dividends for the year of 20. So again, these are the total figures for the year. Okay, first order of business, let's go ahead and determine the cost versus book values equals differential and that sort of analysis. And so we'll start with the cost or fair value. Our share was $164.35. The total is going to be our share plus the fair value of the non-controlling interest. The book value, again, we can do this one of two ways. Simplest way is just to do assets minus liabilities. If you want, you could take the equity balances of $138 at the beginning of the year, add the income to date, subtract the dividends to date. Either one gets you to the same place. So I'm going to go ahead and take the easy route and say it's the assets minus the liabilities. And our share is going to be 95% of that. For a differential, our share 32.3, total 34. Subtract out the undervalued land. Total was 19. Our share of that. So the remainder is goodwill. Okay, when we do our equity method entries, we want the income subsequent to acquisition. Let's go ahead and record the acquisition first. So investment in Little for the cost and credit cash for that amount. So it should be Little, not lit. Investment income. Again, our share 95% of the post-acquisition earnings. So what are the earnings as of the date of acquisition? Well, as of the date of acquisition, we had sales of $172 minus cost of goods sold minus expenses. So $15 of income at acquisition. Total income here was 52, so basically we're going to have 95% of the post-acquisition income. Total income minus income prior to acquisition. And the same thing, that's going to be our investment income. Dividends subsequent to acquisition. Okay, total dividends were 20 for the year. Dividends prior to our acquisition were 14, so there were $6 in dividends subsequent to our purchase of the shares, and so we would get 95% of that $6. And that's going to reduce our investment. Okay, so there's our equity method entries. Now we go ahead and do our elimination entries, and again, basically what we need to do is eliminate the beginning of year owner's equity accounts, common stock 33, retained earnings 105. I'm just pulling this information right off that left-hand margin. We also need to record the differential items, so we're going to go ahead and write up the land by 19, and we're going to record the goodwill of 15. By this point, we should all be well aware that when we do this, we're recording 100% of the differentials, 100% of the land value, 100% of the goodwill value. Now we also need to eliminate the date of acquisition, revenues and expenses, and dividends declared. So basically, we're going to eliminate those four balances that existed on April 1st when we bought this investment. So sales of 172, sales is a credit account, so to eliminate that we're going to debit it for 172. All the expenses and dividends are debit balances, so to eliminate those we're going to go ahead and credit cost of goods sold. We're going to go ahead and credit other expenses. We're going to go ahead and credit dividends declared. Okay, so this total here, that is the date of acquisition value of the subsidiary, book value plus differential. Let's go ahead and add that up. So we got 33 plus 105 plus 19 plus 15 plus 172 minus 83 minus 74 minus 14. So 173, that's the same number as right there. And that's going to be split 95/5 between the parent's investment in little and we could just want to do this. We could do 95% of that number we just calculated, which is also going to be the cost of our share. The other 5% goes to the non-controlling interest, 8.65. Okay, A for amortization, not applicable. I for investment income. We're going to go ahead and eliminate our investment income. And quite honestly, whatever you put as the investment income in your equity method entries, that's what I wanted to see here. So looking at the equity method entries, we've got 3515. That needs to be eliminated. And so we debit investment income, credit investment in little. Dividends declared, again, we've already eliminated the date of acquisition dividends. So of the $20 in dividends, we've already eliminated 14. There's $6 that still needs to be eliminated. I'm going to go ahead and be consistent with my account titles. So div declared, $6. And that's going to get split 95/5 between the parent's investment, and that should be the same amount that we received as cash, 5.7 in this entry. And again, if you want to do that as 0.95 times 6, you get the same thing. And the other 0.3, the other 5%, goes to the non-controlling interest. Lastly, we have the income to the non-controlling interest. Just as we in our investment income had our share, 95% of the post-acquisition earnings, the income to the non-controlling interest is going to be their share, 5% of the post-acquisition earnings. Again, so 5%, 0.05 times, total income for the year was 52, of which 15 was earned prior to acquisition. So there was, $37 of income subsequent to May 1st. That is what goes to the non-controlling interest. Okay. So there's a solution to the mid-year acquisition problem.